In Chapter 5, we are introduced to a couple of terms, FOB shipping point and FOB destination. FOB stands for free on board, and its origin actually dates back hundreds of years to the golden age of global maritime trade and commerce. When goods were loaded onto sailing vessels, getting the merchandise from the seller's dock onto the ship was one of the riskiest parts of the journey. It wasn't easy to get it from the dock onto the ship. And the seller was responsible for delivering the goods to the port and using manual labor or cranes to place the cargo over the ship's rail. The term free on board literally meant that the seller's obligation ended. They were free of responsibility and cost the moment the goods were placed on board the vessel. So hence the term free on board. That was the point where ownership, risk of loss, and liability legally transferred to the buyer. So you can see that as if it's FOB shipping point, the seller transfers the goods to the buyer at the point it gets on the ship. It is free on board, so the seller is free of any obligations. If the goods were dropped into the water while being loaded, it was the seller's fault. So they had to get it onto the ship, and once they got it onto the ship, they were free of obligations. However, once the goods were on the ship, and if the ship left port or damaged later by a wave, sorry, that's not the seller's responsibility. It's now the buyer's responsibility. Today, while goods are mostly handled in containers, these centuries-old terms still dictate two crucial things. So, who pays the freight costs and when ownership, and therefore the risk of loss, and what is in our inventory is legally recorded. So I have a diagram here of the warehouse. So this we are going to say is the seller. And this over here is the buyer. So we have two terms, free on board shipping point or FOB shipping point and FOB destination. The shipping point and destination determine when the ownership actually transfers. So at FOB shipping point, ownership transfers at the point it is on the ship or on the truck. So it doesn't just have to be ships. This could be trucks as well. So as soon as the seller gets it onto the means of transportation, it is no longer the seller's. Ownership has transferred to the buyer. If it is FOB destination, ownership transfers at the point when it is off the ship or the truck or whatever means of transportation you are using. So it's not actually the buyer's until they receive it. So what implications does this have? Well, again, if something happens to it while it is on the ship, whose responsibility is it? So if it is FOB shipping point, who owns it while it's on the ship? The buyer owns it while it's on the ship. So therefore, if something happens to the ship, it's the buyer's responsibility to cover the loss. The seller can wipe their hands of it and say, not my problem. This is your problem. If it's FOB destination and something happens to the goods while it's in transit, the seller still owns those things while it is on the ship. So the buyer says, hey, something happened to the goods on the ship. That's your responsibility. You need to ship me some new stuff because that was the seller's. The seller still owned the goods there. It also has implications about who actually pays for the shipping. Who pays for the shipping? It's whoever actually owns it while it's on the ship or the truck. So if it's FOB shipping point, the buyer owns it while it's on the truck. The buyer is responsible for getting the shipping. So the buyer has to pay for the shipping. If it's FOB destination, the buyer doesn't own it until it gets to them. Therefore, the seller owns it while it's on the truck, and the seller has to pay for the shipping and arrange all of it. And so also, whose inventory is it? And this might be an issue. We're not really covering it in this class, but it does become an issue when we're talking about what is in our inventory. This will come up in later accounting classes. But while it's on the ship, so if you're trying to figure out what is in your inventory, you have to include things in transit that belong to you. So if you are the buyer over here, and you had something that was shipped FOB shipping point, it becomes your inventory as soon as it is on the ship or the truck. So it should be included in your inventory. All right. For this chapter, what we are looking at here, in addition to these terms, is, well, what does this mean for journal entries? Let's look at first FOB destination. So who owns it while it is on the ship? If it is FOB destination, it is the seller. So the seller is responsible for finding the transportation and paying for the transportation. So if it is FOB destination, the seller is probably going to have some sort of journal entry that says they had to pay cash of, let's say, $100 to ship their goods. That is going to go into some sort of expense. The expense that we are going to use is delivery expense. It is the expense of getting the goods to the customers who purchased it. So delivery expense. I also see this as freight expense, freight out, various other terms. Shipping expense, I see that as well. So this chapter in this book uses the term delivery expense, but you might see various other terms used. All right, so usually the buyer has no entries because they're not paying for anything here. Delivery expense is considered a selling expense if you're doing a multi-step income statement. All right, let's go over to FOB shipping point now. If it is FOB shipping point, who is responsible for finding the transportation and paying for it? It's generally the buyer. So if the buyer purchases something from their supplier and it is FOB shipping point, the buyer has the responsibility of finding a shipping company. They could say, hey, call up FedEx, call up UPS, and arrange for shipping. And in that case, the buyer is probably going to be paying FedEx for this. And so the buyer would make an entry like this saying that they paid cash of $100. But instead of putting this in an expense, we have to put it into inventory. Now, why is that? The costs that are included in the inventory account are not just the purchase price of the inventory, but it is everything that is involved with getting the inventory to us and in our store. So this is not an expense, it is part of our total inventory cost. So we're going to put all of those into inventory. You can kind of see an example of this in your personal life. If you purchase something on Amazon, and let's say the item cost $30 and there was $5 shipping, you probably would be thinking in your head, what is the cost of this item? You wouldn't be saying it's $30. In your head, you're saying, what is the total cost of this item to me? It was $35, which is the $30 that you paid to the seller plus the $5 shipping. In your head, you're probably not distinguishing between the two. And it's the same thing with our inventory. There's the price we paid to the seller and the price we're paying to the shipping company. In our minds, it's one and the same. It's all the cost of inventory and getting it to us. There is another situation where the seller might, just for convenience sake, as the buyer under FOB shipping point, we are still responsible for the goods on the truck. But for convenience, the seller might say, hey, I have this arrangement with the shipper. I can arrange the shipping for you. You still have to pay for it, though. And so what might happen is the seller will will actually arrange for the shipping and pay for the shipping, but we, as the buyer, we're still going to reimburse the seller for doing all of that for us. So it might look something like this. On the seller side, they will say, hey, we paid $100 cash for the shipping, but we are going to bill our customer for this. Again, as the seller, we are not responsible for the shipping. We did this as a convenience for the buyer. We got it, but we're going to bill them for how much the shipping actually cost. So they'll just tack it onto the bill. So if the goods cost us $2,000, the seller will tack on another $100 onto the bill that they're sending us. Again, just a convenience thing for the buyer. The buyer will look at it like this. They will put the cost into inventory. Again, this is one of the things that we're not going to distinguish between the cost that the seller is charging us versus the shipping company. It's all inventory. But instead of paying for it right away, we're going to put it into accounts payable. And then, of course, when the buyer pays the seller, we're just going to debit accounts payable 100, credit cash 100, and the seller will now get the cash back, right? So we are reimbursing the seller, and they will credit accounts receivable. So that is kind of a common arrangement if it is FOB shipping point for the seller to actually arrange for the shipping, even though they're not technically responsible for it. If they arrange for it and pay for it, they're expecting to get reimbursed from their customer. All right, so that's kind of an overview of FOB shipping point and FOB destination, all of the journal entries that are involved in that.